Hello everyone, welcome back to my YouTube channel. In the last class, we learned about bill of exchange and promissory note. So in today's video, we will learn three important terms related to bill of exchange and promissory note. They are maturity of bill and discounting of bill and endorsement of bill. So let's start. First one is maturity of bill. What does it mean? It means the maturity of a bill means the date on which a bill of exchange or promissory note becomes due for payment. Clear? It means what? Date on which a bill of exchange or promissory note becomes due for payment. So it is the final date when the amount written in the bill must be paid by the drawee or the person who accepted the bill. It is the final date when the amount written in the bill must be paid by the drawee. Drawee in case of bill of exchange and drawer in the case of promissory note. Means this maturity of bill that is related to both bill of exchange and promissory note. Clear? So it is the date on which a bill of exchange or promissory note becomes due for payment. Means the period mentioned in the bill has ended and the amount is now payable. Now payable. Clear? That is what maturity of bill. Here, how to calculate the maturity date? Here, how to calculate the maturity date? There are two steps included in the calculation of maturity date. That is, first we need to find out the due date. Due date means what? The date on which the period mentioned in the bill expires. For example, it likes 30 days or 2 months or 3 months. Clear? That is what? Due date. We have to find out the due date first. And after that, after finding out the due date, we need to add 3 days of grace. 3 days of grace. Clear? So maturity date means what? Due date plus 3 days of grace. Maturity date equals to due date plus 3 days of grace. Clear? So I will explain this through an example. See here. If a bill is drawn on March 5th for 30 days, bill is drawn on March 5th for 30 days. Means here first what we have to do? We have to find out the due date first. See, when calculating the due date for a bill, the date on which the bill is drawn, here bill is drawn on March 5th, is not included in counting the period. So listen very carefully. When calculating the due date for a bill, the date on which the bill is drawn is not included in counting the period. Here in our example, bill is drawn on March 5th. Means what? Here you should not include March 5th. Clear? You start counting from the next day. Means start counting from March 6th. Now count 30 days from March 6th. Because the bill is drawn on March 5th for 30 days. Clear? Count 30 days from March 6th. March 5th we should not include. Now the 30th day will be April 4th. Means the due date is April 4th. Clear? Now next step is add 3 days of grace. Means these extra 3 days are legally allowed to the drawer or drawee to make the payment. Clear? Now add 3 days of grace to April 4th. Means the maturity date will be April 7th. So the drawee in bills of exchange and the drawer in promissory note must make the payment on April 7th. Because that is the legal date of maturity. Means the day when the bill becomes payable. On April 7th, the bill becomes payable. Clear? I hope this is clear to you all. Maturity date, it is nothing but due date plus 3 days of grace. When calculating the due date, we should not include the day on which the bill is drawn. You start counting from the next day. Clear? That one you should remember. This is what maturity of bill. Clear? So, see next. When the maturity date falls on a holiday, then how we have to calculate the maturity date? When the maturity date falls on a holiday. See, if the maturity date is a public holiday, the payment is to be made on the preceding working day. Means that is nothing but previous working day. Means here in our example, April 7th. April 7th. Suppose this is a public holiday. You have to make the payment on April 6th, preceding working day. Clear? See, for example, if the maturity date of a bill is 15th August. 15th August. 15th August is a public holiday, right? That is Independence Day. So, then the payment should be made on 14th August. What is the rule? If the maturity date is a public holiday, the payment that is to be made on the preceding working day. That is on 14th August in our example. Because if the maturity date 15th August, maturity date of a bill is 15th August, means 15th August. This is the due date plus 3 days of grace. But that day is the Independence Day. That is a public holiday. So, according to the rule, payment done preceding working day means that is on 14th August. Clear? This point is clear, right? Now, next one. If the government suddenly declares an emergency holiday, that is due to any strike, clear? Then the bill is payable on the next working day. Clear? If it is a public holiday, bill is payable on the preceding working day. But if any government suddenly declares any emergency holiday that is due to any strike, then bill is payable on the next working day. Remember this. Clear? For example, suppose the maturity date of a bill is 10th September. Maturity date of a bill directly given means due date plus 3 days of grace. On that day, the government suddenly declares a public holiday, not public holiday, emergency holiday. Clear? Emergency holiday due to strike. Then the bill becomes payable on the next working day. That is 11th September. Maturity date of a bill is 10th September, but government declares the emergency holiday. So, due to any strike, so the bill becomes payable on the next working day. That is on 11th September. Only if that is a working day. Clear? That is also you should remember. So, these are the rules included while calculating the maturity date. Maturity date means what? Due date plus 3 days of grace. And when the maturity date falls on a public holiday, then the payment has to be made preceding working day. Clear? And if the government suddenly declares any emergency holiday, then the bill that is payable on the next working day. But that is the day that should be working day. Clear? I hope this is clear to you all. Now, second term is discounting of bill. Discounting of bill. What does it mean? See, if the holder of the bill needs funds, he can approach the bank for encashment of the bill before the due date. If the holder of the bill needs funds, he can approach the bank for encashment of the bill before the due date. So, the bank shall makes the payment of the bill after deducting some interest or discount. This process of encashing the bill with the bank is called discounting of the bill. So, the bank gets the amount from the drawee on due date. Clear? See, sometimes what happens, the holder of the bill in in bill of exchange or promissory note needs money before the maturity date. Due to any urgency, the holder of the bill, they need money before the maturity date. Clear? So, instead of waiting till the bill matures, the holder of the bill, what he will do? He can take the bill to the bank. He can take the bill to the bank. So, the bank gives him the bill amount immediately. Whether bank will give the full amount, because he wants the amount before the bill matures. Bank gives him the bill amount immediately, but here bank deducts some charges. Clear? For the remaining time till maturity. So this process is called discounting of bill. See, these terms: discounting of bill, endorsement of bill, maturity of bill. These are very important in passing the journal entries. So listen very carefully. Clear? So this is what discounting of bill. Sometimes what happens? The holder of the bill, they needs money before the maturity date. So he can take the bill to the bank and bank gives him the bill amount immediately, but deduct some charges for the remaining time till maturity. So this process, that is called as discounting of bill. Here I will explain through one example. See here. Suppose A sold goods to B. Sold goods to B for rupees 10,000 and drew a bill payable after 3 months. Bill payable after 3 months. Clear? B accepts the bill. B accepts the bill. A sold goods to B for rupees 10,000 and draw a bill payable after 3 months, and B accepts the bill. So after 1 month, what happens? A, he needs cash. After 1 month, A needs cash. Clear? So A, he takes this accepted bill to the bank. The bank agrees to pay him the amount only after deducting a small charge, say rupees 200. Clear? Now A gets rupees 9,800 immediately after deducting rupees 200. Clear? And the bank that will collect the amount of rupees 10,000 from B on the maturity date. Clear? So this is what discounting of bill. That is what discounting of bill. Clear? So I hope this is clear to you all. Now the question arises, why bank deducts some amount? That is called as discount. See, the bank deducts some amount because it gives money earlier than the actual payment date, right? So the deduction, it is like an interest for that advance. So in our example, A holds a bill of rupees 10,000 payable after 3 months. But after 1 month, A takes the bill to the bank and bank gives a rupees 9,800 and that rupees 200, that is deducted as bank discount. Means that rupees 200, it is the interest for using the bank's money for the next 2 months. Clear? So I hope discounting of bill is clear to you all. Now next term is endorsement of bill. Maturity of bill is over, discounting of bill is over. Now next third one is endorsement of bill, and this discounting of bill that is applicable to both bill of exchange and promissory note. And next one is endorsement of bill. So listen very carefully. It means what? It means transferring the ownership of a bill of exchange from one person to another. So this is nothing but transferring the ownership of the bill from one person to another. Clear? Means when the holder of a bill means the person who is supposed to receive the money, signs on the back of the bill and gives it to another person, he is said to have endorsed the bill. The person who transfers the bill is called the endorser, and the person in whose favor it is transferred, that he is called as endorsee. Clear? So endorsement of bill means what? Transferring the ownership of the bill of exchange from one person to another. Clear? When the holder of a bill signs on the back of the bill and give it to another person, he is said to have endorsed the bill. See, for example, if A draws a bill on B, and then endorses it to C. Who endorses it to C? A. Clear? Means here A, he is the endorser, means the person who transfers the bill. Here in our example, A transfers the ownership of the bill. He is called as endorser. And C, to whom he endorsed? To C. C becomes endorsee, means the person in whose favor it is transferred, that is called as endorsee. Here the payment that is done to C, not A, because he transferred the ownership to another person. Clear? So here in our example, B, he is supposed to make the payment to C, not to A. Clear? So this endorsement of bill that is not applicable to promissory note. Here this endorsement of bill that is applicable only to bill of exchange. Why? Because promissory note, that is a promise made by the maker himself to pay. It cannot be endorsed further like a bill of exchange. Promissory note, that is a promise made by the maker himself to pay. Clear? So I hope these three terms are clear to you all. That is maturity of bill, discounting of bill, and endorsement of bill. Maturity of bill. So it applies to both. 1 minute. It applies to both bill of exchange and promissory note, because in both cases the payment becomes due after a certain period, and 3 days of grace are added to find the maturity date. 3 days of grace that is added to find the maturity date. So maturity date means due date plus 3 days of grace. Clear? Now when the maturity date falls on a holiday, the payment that is made on the preceding working day, means that is nothing but previous working day. And if the government that declares any emergency holiday, then the payment that is done on the next working day. Clear? Simple, right? And now next one, it is discounting of bill. Discounting of bill, that is also applies to both, that is bill of exchange and promissory note. Both can be discounted with the bank before the maturity date to get the money earlier. Clear? And next one, it is endorsement of bill. Endorsement of bill. This is applicable to only bill of exchange, not to promissory note. Because bill of exchange is drawn by one person and accepted by another, so it can be transferred to a third party. So but a promissory note, that is a promise made by the maker himself to pay, so it cannot be endorsed further like a bill. Clear? So this is about maturity of bill, discounting of bill, and endorsement of bill. So I hope these three terms are very clear to you all. If you have any doubts, please leave a comment. Thank you.